Now it's time for your Friday Pricing Power Index update with our research analyst, Seth Holm. Seth, it looks like it's favoring the shipper. Tell us about it.
Yeah, thanks, Kyle. Let's take a look at this week's Pricing Power Index. So as you said, the carriers had been gaining momentum in the past few weeks. They got all the way up to 45. Again, 0 is all the way in favor of the shipper, 100 in the carrier, 50 is balanced. But it got in all the way almost up to even, 45 a couple weeks ago, and it's kind of taken a little bit of a step back here in recent weeks, largely due to economic data being pretty poor this week, which I'll touch on in just a minute. So this week's reading is a 30, and I thought I'd hit on some of the components real quick. So looking at OTVI, outbound tender volumes nationally, those are the real big bright spot for carriers. Those are running up 7% year on year right now. That's a really good, strong rate. OTVI turned positive in sort of late July. It's been moving its way up. Now we're on the highs. But the one caveat with that is really if you look back at October of last year, the volumes really started to taper off after the hot 2018. So that's a little artificially high, we think. Like we still expect volumes to stay positive, just probably not continue to run in this 7% level. Then looking at outbound tender rejections, OTRI is about 5%, but again, it's a story of it bottomed out at around 3.8% back in August. It raced all the way up to 6, and it's come back down to the 5 range recently, so that's another reason why this has kind of taken a backseat. And then same story with spot rates. Spot rates bottomed at $1.25 earlier in the year. They raced all the way up to $1.55, and now they're coming back to the low 40s range. We do think there's an encouraging outlook for carriers on the spot rate front because we do expect holiday spending to be good, and that should sort of support those rates and make them firm up. And lastly, just on the negative piece for carriers that really drove the needle this week, economic data, there's just no way to other way to frame it. It was really poor this week and sort of alarming, like all the recession bells are ringing in the media. The ISM Manufacturing Index posted a 10-year low going all the way back to June of 2009. Private payrolls, while the number was okay, we're adding like 70,000 fewer jobs on a 3-month moving average than we were last year. And then the last thing that's pretty negative is the ISM Non-Manufacturing Index. That's a services index. So the narrative in the market has been, yeah, sure, manufacturing is really weak and maybe even recessionary, but that's only 12% of GDP. What matters more is the consumer being strong, which is 2/3 of GDP. But that non-manufacturing ISM came all the way down to 52 this month, which missed expectations of 55, and it's come down from above 60 at the end of last year. So you're starting to see some early cracks in that narrative of the strong consumer. We don't think so much, but it is something to watch going forward. And so to kind of wrap it up, every week we post this article on FreightWaves.com. We also have a forward-looking indicator. So this is real time, right? Supply and demand and pricing power. Looking forward, we think 2020 will be better for carriers, so our outlook is a 55, actually a little bit in favor of the carriers looking out 3 months.
Excellent. Thank you so much. So carriers, maybe you got to weather the storm as time goes along. As it stands today, favoring the shippers. Thank you so much to our research analyst, Seth Holm. We'll see you next week.